This is Macro Horizons, episode 339, Falling into Autumn, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of September 2nd. And with summer unofficially over and the days getting shorter, at least investors can take solace in anticipating lower policy rates, until the data has a vote. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the story was less one of economic data and more one of shifting sentiment on the monetary policy front, specifically as political pressure from the administration on monetary policymakers intensifies. The market is taking this at face value and assuming that the tone shift will simply translate into lower policy rates going forward. As a result, 2-year yields have declined and 30-year yields have been flat or higher. The net steepening of the yield curve implies a greater term premium for 10s and 30s, which is not inconsistent with some of the concerns from earlier this year, a period during which the market was very worried that high deficit spending would lead to greater term premium further out the curve. That's precisely what has occurred, but it has occurred as a function of lower credibility instead of increasing auction sizes. Now, this paints a troubling picture for Fed independence, to be sure, although the fact of the matter is that the trajectory of the labor data implies that lower policy rates should be the path of least resistance in the current environment. Now, whether we'll ultimately get back to truly accommodative monetary policy will be a function of the evolution of the economy and whether or not the Fed is able to forestall a more significant economic slowdown. For the time being, there is some evidence that tariffs have been passed through to the end users. However, as we saw in the most recent CPI print, it was a super core services element that actually propped up the broader inflation complex, which was something of a surprise given all of the focus on the trade war and the implication for goods inflation. It's with this backdrop that it wasn't particularly surprising to see a choppy final week's worth of trading during August with the cross currents of Fed speak and the final coupon auctions of the month, leaving the market in a limited conviction, low-volume environment. Said differently, it was unofficially the final trading week of summer.
While it wasn't necessarily a week that was defined by top-tier macroeconomic data, with the exception of core PCE, that didn't prevent the yield curve from setting new cycle steeps and, in the case of 5s 30s and 10s 30s, reaching their highest level since 2021 as the combination of Fed cut assumptions and the increasingly tumultuous political situation in Washington around the Fed itself has called into question the value of 30-year yields that are still right around 5%. This week's biggest theme was that President Trump announced he intends to fire Fed Governor Lisa Cook, but Governor Cook disagrees. And while we're hardly legal experts, and the actual ability of a president to fire a board member is left to far smarter minds than ours, it's become very clear that in the near to medium term, the administration is going to do everything it can to put, quote-unquote, their people on the FOMC. Now, this obviously has implications for the short-term path of overnight rates, but it also has sparked no shortage of conversations on a broader structural level about what it means for the dollar, what it means for the U.S. more broadly, and obviously the investability of treasuries.
And to your point, it is a credibility issue. If the central bank, for all intents and purposes, has its independence meaningfully undermined, then the operating assumption should be that monetary policy will be easier than it quote-unquote should be. Now, whether that translates through to a race back to neutral or even truly accommodative monetary policy remains to be seen. But regardless, if the balance of risks have shifted towards a needlessly dovish Fed, then it follows intuitively that longer-dated yields should be higher, because implicitly the Fed is willing to accept a higher rate of realized inflation, and therefore longer dated break-even should be higher as well. There's also a higher term premium further out the curve that needs to be considered, and while front-end rates will continue to follow the path of monetary policy and monetary policy expectations, the further out the curve we go, the higher rates become, certainly on a comparative basis. Now, this doesn't mean that 30-year yields are permanently going to trade with a 5 handle. After all, there's only been a few episodes in which 30s have yielded more than 5% over the course of the last 15 years. But it does mean that as front-end yields continue to decline, with 2-year yields currently at roughly 360, that the long bond is going to lag in its performance. Even the 10-year sector, with 10-year yields currently at 425, has underperformed what one might have otherwise assumed given the looming shift in monetary policy, as the Fed readies to lower monetary policy rates by 25 basis points on September 17th.
And this dynamic represents one of the ironies of everything that's playing out in the market at the moment. When President Trump and Secretary Bessent took office, they both made it clear that yes, they wanted interest rates lower and the Fed to continue cutting because, after all, especially as midterm elections loom on the horizon, what sitting administration wouldn't want the strongest economy possible? But to your point, Ian, the fact that this pressure is coming in the form of lower overnight rates is, and the ironic bit, coming at the expense of longer dated yields, and the fact that actual economic activity is driven far more by 10-year yields than it is by overnight rates. The efforts to impart a dovish bias on the Fed by President Trump is actually pushing more term premium into the curve, pushing long-end rates higher, and undoing some of the progress that Secretary Bessent made on the issuance front, and helping calm concerns that ballooning Treasury issuance was going to inevitably lead to 30-year yields being at, let's just say, 6%. So as we learned from Powell at Jackson Hole, the Fed is going to be cutting in a couple weeks. And regardless of who is or who is not sitting on the FOMC, that was probably always going to be the case given what we've seen in the latest payrolls and CPI reports. And so now, as investors continue to ponder what a more politically driven Fed means for the appropriate level of longer dated yields, it seems that President Trump and Secretary Bessent are facing a conundrum of their own.
And this all comes with the backdrop of the administration's pushback on the economic data's reliability following the big BLS revisions and the shifting of leadership at the Bureau of Labor Statistics. And this has further contributed to the underlying uncertainty that has weighed on duration and pushed longer dated yields higher. If investors have lost faith in some of the major economic releases, the marquee data point in this context being the payrolls report, then what is the market left to trade off of, if not supply and demand concerns and the political crosscurrents in Washington at the moment? So, to a large extent, we're sympathetic to the recent steepening of the curve, with the push towards lower front-end rates really driving the bulk of the repricing, while the long end simply lags. However, it's not difficult to envision an environment in which the economic data, while perhaps not perceived to be as reliable as it was a few months ago, continues to show a deceleration in the labor market as well as relatively benign tariff pass-through to core inflation. All of this sets the Fed up not only to cut 25 basis points in September, but also to deliver a comparable cut in October and in the year with another 25 basis point cut in December. What will be particularly interesting coming out of the September 17th FOMC meeting will be how the Fed chooses to update the SEP and the beloved dot plot. In the event that the Fed drops the year-end forecast for Fed funds by another 25 basis points, that would represent a clear signal that the Fed intends to move 25 basis points in October as well as December. And depending on how August's payroll and CPI figures come in, that could ultimately be the path of least resistance.
And that is really the biggest question of the moment. What will next week's payrolls report reveal in terms of the pace of hiring in August, and will it confirm some of the weakness that we saw in July's numbers, or push the market back to the place that it was earlier this year, where a generally solid, if not necessarily screaming stronger, labor market kept the wait-and-see stance from the Fed intact and cemented the trading range in treasuries that really dominated most of the early part of summer? You touched on it as well, Ian, that there's also the tariff concerns to consider, and on a component basis, what we saw within the last CPI report, and the fact that it was more services rather than goods inflation that were the sources of strength within the CPI, all with a positional backdrop of a market that continues to expect wider break-evens, partially as a function of a more dovish Fed. All begs the question of what would come to pass if we get a very strong payrolls print next week, and then maybe an inflation report that shows, again, firmer services inflation. Barring truly massive upside surprises following what we heard from Powell in Wyoming, we don't think either of those realities would really be enough to 100% take a September cut off the table, but it would certainly be sufficient to trigger a rethink of what the shape of the next leg of the easing campaign will look like. Is it going to be 25 basis points at every meeting, 25 basis points quarterly, potentially a 50 basis point cut? It's a version of data dependence, but clearly with a more dovish departure point than has been the case in quite some time.
And it also does put the onus on the economic data to determine how the market will perceive the 25 basis point cut in September. It's not difficult to envision a scenario in which a stronger payrolls report, combined with the revelation of higher core goods inflation, really puts the September cut in the context of being politically motivated. I think that at this moment, that's the key risk to Fed independence. So from the Fed's perspective, at least Fed independence, the worst case is the best case for the real economy at the moment.
Which is a version of bad news being good, and especially given risk assets that continue to perform well, in no small part because of the assumption that lower interest rates are coming. It's going to be very telling to see the interplay between financial conditions and the economic data, if in fact that feedback loop reemerges. Stronger economic news resulting in tighter financial conditions puts the Fed in an odd place in terms of calibrating their needs to cut, while bad economic news and what that implies for more cuts would actually fuel greater easing of financial conditions. And while from the current departure point, especially given what's going on in the labor market and inflation realms, we think it's unlikely that stocks' performance are that high up on the list of factors driving monetary policy decisions, but especially as we head into September and what has historically been a rough month for stocks, it's food for thought as summer unofficially comes to a close and the market begins to prepare for what promises to be a very exciting Q4.
And with college football restarting this weekend, we're reminded that if you can't do it in the first three quarters, you got to count on Q4.
I didn't know you were a tennis guy.
In the week ahead, the market returns from holiday, and we have a full range of economic data to provide incremental trading direction in the U.S. rates market. The marquee release will be August payrolls data. However, given the amount of scrutiny currently being placed on the BLS following the massive revisions that we saw with the last report, we're left to ponder the degree to which the market will be willing to trade the BLS employment report to the same degree that it might have otherwise. Keep in mind that those significant revisions brought the official BLS data back closer in line with what ADP had initially printed, and as a result, we expect that the non-BLS data in the week ahead will have a disproportionately large impact on the outright level of rates. Specifically, on Tuesday morning, we see the ISM manufacturing print. Now, this will be data for the month of August and will include the employment component. Similarly, on Thursday, we have ISM services, again for August, and also including the employment component. Those two, combined with the ADP print on Thursday morning, will contribute to investors' broader understanding of the overall health of the labor market. And in the event that there's a significant disconnect between ADP and the BLS payrolls print, it will be very interesting to see which of the two data series carries more weight. We've long lamented the fact that ADP had been a market mover, but in light of the significant revisions, we think that there is now greater validity in letting ADP set the tone. Ultimately, while in a traditional environment, one might look to the combination of payrolls and the following week's core CPI print as being determinant factors for the September 17th FOMC decision. The reality is that a 25 basis point rate cut is already a foregone conclusion. We don't see a viable path to cut 50 basis points in September, even if there is a weak payrolls report and softer inflation data. Instead, that would simply translate into penciling in October as well as a December rate cut. Said differently, While the forward path of monetary policy expectations is very much in a data-dependent mode, it's a matter of how many quarter-point cuts the market should be assuming, as opposed to how large of a September cut the market will price in. We've been encouraged to see an unwillingness to price more than 25 basis points worth of rate cuts in for the September meeting, and we expect that even in the event of disappointing data over the course of the next 2 weeks, that an attempt to price in 50 basis points will ultimately prove to be a fade. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as the focus shifts to the payrolls report, we're left to ponder, if we cannot believe in the labor data, can we still believe in Labor Day? We'll see on Monday. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.